Welcome back to Lesson 15.3 on adjusting accumulated depreciation. It's just another adjustment that we're going to make for a corporation, and we're going to learn how to calculate the expense for one method and then adjust the accumulated. So let's get some background information first. So businesses have multiple classes of assets. They have current assets and they have long-term assets, which are also called plant assets. Current means that they will be exchanged for cash or consumed within a year. Physical means greater than a year, so multiple years of use for those assets. So we have cash, accounts receivable, prepaid insurance, supplies, marketable securities that are less than a year of maturity. Those are current assets. Plant assets are things like equipment, building, land, things that are going to be lasting for longer than 1 year. So we have to depreciate plant assets. So a loss in the usefulness of the plant asset as a result of wear and tear or obsolescence is called depreciation. And we are required under GAAP, again, generally accepted accounting principles, to match revenue with the expenses used to earn the revenue. So the cost of that plant asset that we're using to generate revenue has to be expensed over the asset's useful life as we are using it to generate revenue. And that portion that is transferred to expense from that plant asset or that asset each fiscal period is something we call depreciation expense. So there are three factors that are really considered very important in calculating the annual amount of depreciation expense. And you absolutely have to know these for every thing that you do in order to calculate depreciation. So we have a slide on each of them. So the first factor that matters is original cost. And original cost is the price that you paid to buy the asset and to make it usable to a business. So if it requires installation, cost, shipping to get to you, any of that kind of stuff, all those costs would get included in the cost of the asset. Then we have salvage value. So salvage value is an estimate of the amount that will be received for an asset at the time of its disposal. So salvage, disposal, residual, scrap, that's all the same thing. So what's the amount that we could receive at the end of its life or when we're disposing of it? Since it can't be known when the asset is bought, this is an estimate. So I think we've talked about this before. SWAG, serious wild ass guess. So it is an estimate. It's judgment that's involved for salvage value. Original cost, factual, no judgment. Salvage value, a fair amount of judgment. And then the final factor that we look at is useful life. And this is also a judgment call, but it's with our eyes wide open we can make that judgment. So it's the period of time which we think the asset's going to contribute to us earning revenue. And our total amount of depreciation expense is going to be distributed over that estimated useful life. So we're going to say that we're using it regularly over however many years. And there are two factors that affect that guess, and that's physical depreciation and functional. And we're really not going to go into any discussion about that for our purposes at all in calculating. So the method that we're going to use, and there are 4 methods that are allowable under generally accepted accounting principles, but for first year accounting, we're just going to look at straight line depreciation. So straight line says we're going to record an equal amount, and that is key, an equal amount of depreciation over its useful life. So that is the easiest, it is the most commonly used without a doubt. So let's look at how we're going to compute that. We take the original cost, which includes everything to get it usable, minus its salvage value, what we think it's going to be worth or we could get out of it at disposal, and that's our total depreciation expense for the entire period. And you guys do have this handout, I believe. And then we're going to take that estimated total depreciation and divide by useful life to get an annual amount that we're going to depreciate. So you can see for an asset there, we said originally $2,500, salvage at disposal we'd get $500, so $2,000 over 5 years we would do $400 per year. So another account that we have is called accumulated depreciation, and as the name sort of indicates, it's the total amount of our depreciation expense that we have recorded on an asset since we purchased it. And to calculate the accumulated depreciation, this is saying in year 2000 x2, so the second year's accumulated depreciation for that asset that we had the example on would be $800. It was 2 years of $400, and then in year 3 we'd do another $400, so then we're up to $1,200 of accumulated depreciation. And then x4 we would do 400 more, and accumulated would be 1,600. And then x5 we would do 400 more, and accumulated would be $2,000. So it's just keeping a running total, basically, of all the depreciation expense since we started. Then there is something called book value. The book value of an asset, just like the book value of accounts receivable, was accounts receivable minus the allowance for uncollectible accounts. Then for a plant asset, it's going to be the original cost of the plant asset minus accumulated depreciation. Okay, that is a contra asset account. I want to make sure you guys know that. Accumulated depreciation is a contra asset account, which means it has a normal credit balance. It goes up as a credit, it goes down as a debit. So original cost was $2,500. At the end of the third year, the accumulated depreciation was $1,200. So the book value of that asset, what we think it's worth really, is $1,300. So what is the journal entry that we make? And I'm just going to do it here. So the journal entry that we make, if we calculate what the depreciation is, and we're not going to go through that, we'll do it in a problem. We debit expense and we credit accumulated depreciation. And these are the different classes of assets that we have. Store equipment, office equipment. So debit the expense called depreciation expense office equipment, and then credit the contra asset account called accumulated depreciation office equipment. We're going to close this account out every year as we do all expenses, but this one, because it's contra asset, just keeps accumulating then what that depreciation is since we purchased the asset. So that is the journal entry that we are going to make. And I just want to quickly go through this because this really does summarize lesson 15.3 very well. So it says, what are two categories of assets? They're current assets and plant assets. Again, within a year, less than or equal than a year, greater than a year on plant assets or long-term assets. The three factors that matter: original cost, salvage value, useful life. This is a factual number to get it into use. This is an estimate of how much it'll be worth at disposal. This is how long we think we can use the asset. And then it says what plant asset account does not have a contra account for accumulated depreciation, and I don't think I mentioned this, that's why I wanted to do these, is land. Land never depreciates in value. It is always there. It is always going to last. There isn't wear and tear on it in accounting terms. And then how does an adjusting entry for accumulated depreciation affect the related plan asset? It doesn't change the asset itself. It changes the contra account, accumulated depreciation, and it obviously affects depreciation expense. So expense and the contra asset are affected, but the asset itself, equipment, is not affected in the journal entry. And that is all we have for this section.